Thank you. I think in the first place, we need to cast our minds back to pre-2009 when the CP market was quite buoyant, if I use the word buoyant, right? You had a lot of activities around the CP market. You had a lot of corporates, both financial and non-financial institutions. But in 2009, there was need to revamp that sector and bring out some form of structure, and the market went quiet. But what FMDQ tried to do is to diversify the market. Because today what you have is people either buy bonds or T-bills or stocks and all of that. But what the CP really did was to create a stopgap. So if you had corporates that needed to raise short-term funds within 270 days, 90 days, 180 days and all of that, so they step into that market and then they can access the market. Now, the 1 trillion mark, it's a significant one for the CP market today. Why? If you look at what investors really look at today, we know what the T-bills market is doing. We've left the 18 levels, we're down to 12 levels, 12.5. The bond market is hovering around 13%. So what's your next point of call if you want to invest? The CP market, exactly. The CP market is where you can have that. And don't forget, corporates have a choice to go to banks to borrow, at probably 19, 20, 18, 21.
Depending on the quality issue.
Exactly.
Probably so more towards 20 plus.
Exactly. But for the CPs, maybe you find 15, maybe 16. At 16 or at 15.5, it's a lot better because it's 270 days as against a 270 days T-bill you will find in the market. So in real terms, I think they've done well. In terms of how we can trade it, I think the market will get back to that point. What's important is that you can have a lot more issues and then people can have it either to hold to maturity because it's short-dated anyway.
But typically the issuers of these CPs, do you see them rolling, reissuing as a way of refinancing when that 270 days period elapse?
A number of them can. That's a fact of life. So,
but is that typical? Because if I wanted to plot a strategy to begin to invest in CPs, it would be nice to know potentially what are my options when I exit.
I think the important thing we must understand about the CP market is that there are two things. One, it has to be trade-backed. Secondly, you can't hold more than 150% of your shareholders' funds. So you need to be careful how much you want to issue vis-a-vis how much you want to hold. Because one of the things the central bank has tried to do is to regulate that market so we don't go back to where we were in 2008 and 2007, where people just, by signing a note, you can actually roll it over, as against going through the process of issuance, which is what FMDQ is trying to do today, create some standards. So you could go back to FMDQ, go through the normal process of reissue or extension or all of that. But what is important is that that market is there. So if you liquidate after 270 days, you are free to come back and reissue. And one of the things I've even seen is that they have a program. So you can issue an amount and then you could go back upon maturity, then you issue yet another amount. One thing that is really important, I think investors and even issuers need to understand is that that platform is there. That market is there. There are people willing to tap into that market either from the perspective of investors or from the perspective of issuers.
And I think the environment is probably making it even more attractive because as the T-bill yields come down, banks and perhaps other potential investors are now looking at options. And so if the CP market is developed and continues to develop as you suggest, then obviously that is a viable option for investors. Can you give us a sense of the yields that are available in that market right now?
I think I've seen around 15 levels, 15.5 levels. The lowest I've seen is around 15, right? You have a couple of them out now. Sterling Bank just issued recently Nigerian breweries, and UPDC also issued recently. So you've had, I think IBTC had one at a time. So you've had a couple of both manufacturers and guys in real estate. To a large extent, right? As long as rates continue to trend lower, you always find people want to have a mix in their portfolio. So if you are willing to take on the risk of blue chips or issuers, as it were, then you can go ahead and buy CPs.
So let's go away from the registered commercial paper programs now. Let's have you give us a general sense of how the markets are doing at this time and what's driving the FX space.
Okay, I think two things. In the first place, the level of flows we've had from FPIs in the last couple of weeks, or maybe a month or two, seems to be dwindling, right? And to my mind, two things really drove that effect. One is the fact that some of these FPIs are rebalancing their portfolio. We've seen them move from the bonds market and move into the T-bills market. So it suggests that as we go further into the year and then the election thing seems to be coming to bear, people are trying to be cautious to see how well we're able to deal with the election, which to my mind, it won't be any different from 2015. I think it's going to be peaceful. I think we're just going to have an easy election and just cross over. But it's okay for them to watch. And so that in itself has reduced the flows we had from the FX. The other is that by June, July, down to Q3 is when we typically have the peak in FX demand because people want to bring in goods ahead of the Yuletide season and all of that. So we'll expect to see increased demand around this period. I don't think it's so much to worry right now, but it's okay to note it that for the first time in recent times, we find the reserves dwindling. But I think it's typical around peak period demand as we go from Q2 into Q3.